Hey everyone, welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor. And today's video is not gonna be about a particular company or a particular stock or a particular business, but rather a general overview about the stock market and what is going on with the stock market. So for those who don't want to watch the complete video, I'll just summarize the content right now. So what we are going to cover in this video is what actually happened on last Friday, why there was this panic sell-off, and how we could hedge our portfolio against inflation, what will be my strategy, and of course some bit and pieces of some new information or some news regarding the Chinese stocks and Didi Global and Alibaba and so on and so on. And now for those who want to stick around the full video, let's jump into the content.
Okay guys, so to understand what is actually happening with the stock market, we need to understand what is driving the stock market and how the stock market momentum works. So in my opinion, the stock market momentum is based on two factors. Short-term based momentum, which is based on the liquidity, that means how much money is floating in the market, or based on the velocity of money, that means how much money is being printed or is accessible by us retail investors to spend in the stock market. And that is what was happening, and this is why we were noticing huge spike on many growth stocks, and yeah, S&P 500 is at all-time highs and so on and so on. So this is the factor which actually drives the stock market in short term. Yeah, this is very important to know that this is just for short term. Now, the other important factor is what is worth noticing to hedge your portfolio, or to know, to understand, so that you don't worry about your businesses which you're buying. So which is long-term based momentum. So long-term based momentum is very important because the stocks will eventually come back to the levels where they are matching with their fundamentals. And that is why, in my opinion, this is the time when you see a huge correction or when you want to hedge your portfolio, it is always nice to invest into the companies which are properly valued or which are undervalued or which simply has enough cash flow to survive during high inflation, because high inflation means the rates will rise, and the rates for these companies to buy, for example, fuel for their transportation will also rise, which eventually eats upon their profit margins. And that is why companies with good profit margins and good cash flow are worth to invest in such situations. And guys, this principle of investing is not just to hedge your portfolio against inflation. I mean, if you follow these principles, if you follow the fundamentals, if you just try to evaluate a company and be conservative, such type of portfolio can actually wither any storm. Yeah, pandemic, inflation, any economic hindrance which could come in the future. Such type of investment can really wither any storm, and that is what is the purpose of this video, to let you guys know what kind of investing is actually helpful to make your portfolio grow regardless of which economy you will be in the future. So this is value investing, guys. So anyways, these are the two important factors which should be understood before we move on to see or to understand what is actually happening with the stock market, what the stocks are falling down. Okay guys, so before we move on to other important topics in this video, like why the stock market might be falling, how we could hedge our portfolio against inflation, and some other important piece of information, I would like to share one important thing which might be helpful for you guys. So there are different strategies which one can follow to invest. So either based on risk profiles, so it is on your self risk tolerance that you can either be conservative and invest into businesses which are undervalued, yeah, or maybe you think which are undervalued according to your assumptions, or you can be a bit moderative, so in between being conservative and being aggressive. And the third type is you can be fully aggressive and invest into just growth companies which you think in the future can have huge growth, but then you don't see the valuation, you don't have to bother about intrinsic values and stuff like that. Yeah, so in this situation, in such economic crisis, what I'm doing is that I am being more conservative, I'm being more on the value investing side, because I believe in companies at this moment, that the companies which have really good cash flow, they have really good bottom line figures, and they are pretty undervalued with respect to the industry as an average and compared to their competitors. And like I said, you can either be on this side or you can be as a growth investor, and you can compare the top line and bottom line figures compared with its peers or the industry average. But then, like I said, you should not be bothered about the valuation of the company, valuation of the business. That is more aggressive, I would say. And then you can be one of those persons who is just following income investing. That means investing into businesses with dividend yields, or you can earn interest on your income, or real estate or bonds. Let's say what I'm doing in this stage, and this is not a financial advice, and I'm not recommending you guys to follow one or the other strategy. I'm just letting you guys know that what you could do, and in the best scenario, in my opinion, is to put more chunk of your portfolio into value investing, and then just diversify between growth and income investing, because there are many companies who are paying off really good decent amount of dividend but are also undervalued. So there could be a good combination between income investing and value investing. And on the other side, if you want to be one of those aggressive investors, then do by all your means. But again, in my opinion, that is not the ideal situation which one should be following in such scenarios. Okay guys, so with that being cleared off the table, now let's discuss why the stock market actually fell on Friday. What was the reason behind this panic sell-off? So the first reason is, of course, inflation. Now, this has been discussed since months, but the October numbers made it worse. The US reported all-time highs inflation numbers, and the percentage was around 6.3%. And this is a long-term lasting reason. Now, it depends on various assumptions. Many people would argue with that it is a temporary phase, which I want to believe also. But I am right now strategizing my portfolio, thinking and being conservative, like I just mentioned before, thinking that the inflation numbers, okay, won't be that high, 6.3%, but it would be somewhere around 3 to 4%. These are my assumptions, and based on these assumptions, I am strategizing my portfolio. Now, the second reason for the panic sell-off was the new variant of coronavirus, which was found in South Africa. And this acted as a spark to worsen the sell-off. And like I mentioned, guys, these two news on top of each other created this panic on last Friday, the last trading day, which actually resulted in a beautiful sell-off. Why beautiful? Well, because for me, this is an opportunity. So anyways, global shares are up by 16% this year, weathering a plethora of risk after investors poured almost $900 billion into equity exchange traded and long only funds in 2021. And this is what I mentioned in the very first slide, guys. The liquidity of money and the velocity of money. So there is so much money floating in the market because there was so much money being printed in 2021 and 2020 that this money eventually will be taken out of the stock market at one or the other point, because inflation, with the rise of inflation, people would need money to spend on their consumer products. Now there was so much money being printed and there was so much extra money in the economy floating around that people just wanted to spend, and they could not spend at any other thing because of lockdown, so they put and poured money into the stock market. But with the economy reopening and inflation rising on top of that, people would tend to take out this money from the stock market because they would need money, as simple as that, to spend on daily products for living. That's it. And this is how, guys, inflation could be a bad news for the stock market. But before that, we need to understand the relationship between inflation and interest rates. So this is the chart showing the last 50 years, the relationship between inflation and interest rates. And as you can see, in 2020, the inflation is quite high, but the interest rates are still at all-time lows as compared to 2010. And that means that the interest rates would eventually have to rise, because this is the only way to fight inflation. The government has no other way to fight inflation, and the interest rates would eventually rise. Now, how that would affect the stock market? So this is a 10-year treasury yield bond, which is at 1.48. So this means that if somebody would buy this bond, they would get a return of just 1.48%. Now, this is direct correlation with interest rates. So if interest rates will rise, the 10-year treasury yield will rise as well. And this is one of the safest, this is the safest investment, because this is 100% return, guaranteed return. But now, why would anyone invest into 10-year treasury yield with a return of 1.48% when companies like even Johnson Johnson's dividend is giving you more than 1.4% return, right? So there is no benefit of investing into 10-year treasury yields. So the big giants are not investing into bonds right now. But with the rise in interest rate, because the inflation is peaking like hell, this will eventually rise. And if this crosses 2, 3, 4%, just imagine if the interest rates are going back to 2010, 2012 levels, then the money will eventually come out of the stock market and the big giants would be ready to invest into a 100% safe guaranteed return of 3 to 4%, which is the 10-year treasury yield, and that would eventually mean that the money would be taken out of the stock market and will be put into the 10-year treasury yield. As simple as that, guys. And this is why the rise in the interest rates could be a bad news for the stock market. So guys, before we move on, I would just like to point out one important piece of information for all the retail investors out there who are invested into Chinese market. So recently on Friday, the Chinese regulators actually requested NYSE to delist Didi Global. Now, why this information or news is important? Because this could eventually affect our other Chinese stocks like Alibaba, Tencent, Baidu, or all the Chinese stocks for a matter of fact, yeah, which are globally trading. In my opinion, this is nothing to worry about, but of course, many other retail investors might think that this danger could eventually come on other big tech giants from Chinese market as well, or on all other Chinese stocks, right? But why I'm not worried about this? Because in my opinion, guys, Alibaba, Tencent, Baidu, these are big tech giants. And if China wants to be a global leader, why would they spread negativity for their biggest tech giants who are literally printing machine for the Chinese economy? I mean, if they want to make a global name, global mark, they would not, I don't think they would be asking to delist their biggest tech giants, right? This is just my opinion. Of course, I don't know the future, and for sure, I cannot read the minds of these Chinese regulators because, in my opinion, this is illogical. But of course, they might have their own reasons, and blah blah. So, I am not worried about this, but of course, this could be taken in another way by many retail investors, and we could see a further sell-off for our other tech stocks from Chinese market. And that is why this is important for you to strategize your portfolio regarding your emerging markets or Chinese market. So that's why I just wanted to point out this information. For me, it doesn't matter at all. I would still be averaging down my Alibaba and Tencent position. And yeah, that's all, because I trust the numbers and the numbers are pretty amazing, guys. I mean, it's getting just undervalued like hell. So anyways, guys, let's move on. So in my opinion, a general principle for inflation hedging is to first of all buy those companies who have inflation hedged business contracts, or also called as oligopolistic business contracts, because in these contracts they have the power to pass on the higher cost to their consumers. Okay, we'll get on to some examples further in this video as well. The second way is that to buy those companies who are paying good dividends, but the condition is that these companies should have a good asset to debt ratio. That means they should not have a large amount of debt, plus they should have a good cash flow, and their payout ratio should not be that high from their cash flows, because that means if they are spending a lot of cash just to pay out of their dividends, then they are not investing this amount of cash back into their business, which in my opinion is not that good for a company to grow. Anyways, so these are some conditions which are important to realize and to understand before you go on to buy a company which has a really high dividend yield of 8-9% or whatsoever. A high dividend yield doesn't mean always that it's good. The company should be consistent, and this is what I am always discussing with my Patreons, and this is not any kind of a financial advice, guys. Okay, so these two things are important to understand if you want to hedge your portfolio against inflation. Now, one important thing which I would like to point out here, which is again not any kind of a financial advice, none of this is a financial advice, but this is just my personal opinion, and this is what I am also using in my benefit. So if you expect inflation to rise, actually it could be a really good time to be a borrower. That means taking some credit, because this will eventually mean that you are actually repaying your debt with cheaper dollars in the future. Yeah, and it can even get better if you take this credit to put on to some asset class which is also appreciating over time. So you're repaying your debt with a cheaper dollar, plus your asset class is also appreciating over time. And this is why I mentioned that 90% of my investment of my portfolio is into real estate right now, because the interest rates are at all-time lows in Germany as well. And yeah, this is what I wanted to tell you guys, and this in my opinion is quite a reasonable thing to do, especially in case of rising inflation. So moving on, as we see here, this is the JP Morgan's report for different asset classes at different types of inflation. And you would be surprised to see that if you see here rights at all time of inflation periods have performed quite amazingly good. And this is why, again, like I said, I am heavily invested into real estate. Now guys, if you don't have enough money to buy a real estate, of course you can also buy companies stock which are rights, that means real estate investment trust, which are trading on the stock market. But please be careful, not all rights are good to invest, okay? Because many rights can have huge amount of debt, especially those who were into the office market, providing offices, and during pandemic there were no offices rented, and there were home offices, so they had a huge amount of debt. So this is really important to understand and to actually notice before you buy any right on the stock market. So like you can see, equities and value stocks have also performed quite good in any of the inflation class, but rights, in my opinion, have performed pretty decent, and they were quite steady. So this is what I wanted to show you guys, that this is one of the ways how you can actually prioritize your portfolio and strategize your portfolio depending upon what you think about inflation. So guys, like I said, I will give you some examples how I'm hedging my portfolio against inflation and giving you oligopolistic stocks. But again, guys, this is not the only problem which I'm hedging my portfolio against, okay? My portfolio, I'm buying companies and assets in my portfolio which I think can grow in years, over the years, regardless of inflation, deflation, whatever. Because sometimes if you buy companies which are just hedging against inflation, yeah, during deflation you might not see any growth, okay? So that is not my general principle. My general principle is to buy those businesses who, despite of any economy barrier, they would be growing. So anyways, these are some of the examples from my portfolio. So one of the stocks or the businesses which I have been buying is Brookfield Infrastructure, which has been showing 30% year-over-year growth from their funds from operations. That means the profits from the operations which are from passing on the cost to their consumers. Then PayPal also, of course, PayPal is still a bit overvalued, but I still think that if it comes down, I will be bulking up more on this particular company, because they also have a top line growth from their PayPal checkout, which is actually also a beneficiary of inflation. Now, Linde, one of my favorite German companies and businesses which have also oligopolistic business contract, because they have the power to pass on these higher costs to their consumers, and they have a solid cash flow, guys. And also on top of that, they pay a dividend yield of 2%. So that is why Linde is for sure going to stay in my portfolio. Then, like I said, I have been buying more dividend paying stocks with a good history, decent payout ratio, and strong cash flow. I have made a complete portfolio and I have passed on to my Patreons. And if you are interested to join my Patreons group, the link will be in the description below. Then, of course, real estate or rights. I have invested more into real estate, physical real estate. So that is what I'm doing recently because of the low interest rates, and commodities as well. For example, Nutrien is one of really good commodities, and of course crypto and collectibles like NFTs to hedge against inflation. And then at last, I have not stopped spending my money, which is my SIP program, into ETFs, because I still want to diversify my portfolio in the emerging markets, in different sectors of stock market. So this is what I have not stopped. I've just reduced my amount per month on the growth ETFs, because I think they will fall down with rise of inflation, but I have not stopped. So yeah, guys, that's it. That's all how I have designed my portfolio to get a deeper analysis and to get a deeper view into my portfolio. You are most welcome to join my Patreons community, and I'll be happy to help you guys and yeah, give my advices, which are not financial advices, but just to help you guys out And yeah, that's all, guys.
So that's it, guys. That's all for today. And I hope that I was able to provide the right information to you guys and you understood everything and there won't be any misunderstanding and you won't be taking this information in any other way. So this was just to give out my personal opinion. So none of this is a financial advice and I didn't recommend any of you guys to pick up those stocks or follow those strategies. That's just my own personal strategy. And if you want to see my complete portfolio and you want to see what changes I've been making in my portfolio, then you're most welcome to join our Patrons community and the link will be in the description down below. So yeah, you're welcome. And with that being said, I will see you in the next one, guys. Till then, stay safe, stay healthy, and ciao.